Imagine the stock market crashing tomorrow. What would you do if your investment suddenly vanished? It's a terrifying thought, but understanding the signs that a crash is coming can help us prepare and avoid financial catastrophe. Let's jump right to these signs. First up, over-exuberance in stock valuations. Think of the dot-com bubble or even the housing market frenzy. Historical data shows that when the market's price-earnings ratio skyrockets beyond historical averages, a downturn often follows. It's like the Roaring '20s, when stocks were wildly overvalued just before the 1929 crash. Next, declining corporate earnings. When companies across sectors report decreasing profits, it's a red flag. In 1929, despite the external optimism, many corporations saw their profits shrink, foreshadowing disaster. Today, if we're seeing widespread earnings declines, it's wise to be cautious. Finally, consider excessive debt levels. High margin debt, where investors borrow to purchase stocks, can signal danger. Before 1929, margin buying fueled the bubble, and when it burst, investors were wiped out. Compare this to our current high debt levels. Unsettling, right? Understanding these signs helps us invest wisely. Don't forget, history doesn't repeat, but it often rhymes. Let's unpack this a bit more. Excessive debt can act like fuel to the fire during a market upswing, amplifying gains when stocks rise. But here's the kicker. When things turn south, it magnifies losses even more. So, a high level of margin debt can lead to forced selling, making market downturns steeper and scarier. In 1929, this very domino effect played a pivotal role in escalating the crash. Now, shifting gears a bit, let's talk about that unsettling feeling of déjà vu. Consider today's global economic uncertainties. The geopolitical tensions, trade wars, and even pandemics have ripple effects on the market. Back in 1929, international instability and trade issues contributed to the financial collapse. Sound familiar? Today, with globalization, even a seemingly isolated issue can shake markets worldwide. It's crucial to keep an eye on these global signs. If we look at the interconnected nature of today's world economy, we notice that financial health doesn't just depend on local markets, but truly is a worldwide game. So what can we do with this information? Well, being informed is our first step. Look to diversify, consider safer investment options, and stay agile. Prepare for fluctuations as if they're inevitable. Embrace the unpredictability of the market, leveraging it to protect or even grow your investment. Let's shift focus to investor sentiment, an often overlooked yet powerful market driver. Right before major downturns like 1929, investor optimism reached fever pitch. Everyone believed that the market could only go up, creating a bubble of false security. Today, the messaging across social media, finance channels, and investment forums can fuel similar sentiments. When you hear stories of everyone making a killing on stocks, it's easy to get swept up. But take caution. Historically, such widespread optimism can signal overvaluation. Remember the phrase, when even the shoe shiner starts giving stock tips? It's a humorous, yet telling signal that the market might be overly hype-driven. Now let's pivot to a crucial reality check: liquidity. Think of it as the financial system's fuel. In 1929, a lack of liquidity exacerbated the crash as banks failed. And today, central banks play a massive role in cushioning this. They inject money to stabilize economies, as seen during recent crises. However, this isn't foolproof. If liquidity dries up or interest rates spike, markets can become jittery. So, what's our takeaway here? Always be on your toes. Don't just ride the highs. Have a strategy that anticipates shifts. Stay informed, diversify, and keep a cool head amid the market's roller coaster ride. Remember, insight and preparedness turn uncertainty into opportunity. Speaking of strategy, let's discuss diversification, a cornerstone of risk management. In times of uncertainty, having a spread of investments across various sectors and asset classes can cushion against losses. It's not just about stocks and bonds. Consider real estate, commodities, or even alternative assets like cryptocurrencies. Think back to 1929. Those who put all their eggs in one basket suffered massive losses. Modern technology offers us the tools to diversify not just nationally but globally. By spreading your investments across different markets and economies, you can reduce risk and stabilize returns. With the rise of technology, maintaining a diversified portfolio is easier than ever. Robo-advisors, for instance, help allocate assets based on your risk profile, automating the diversification process. Plus, with fractional shares, it's now possible for investors of all sizes to access high-value stocks. Finally, staying updated is key. The financial landscape evolves rapidly, and today's macroeconomic signals can shift at the blink of an eye. Follow credible financial news, subscribe to investment newsletters, and perhaps most importantly, engage in communities where insights are exchanged and discussed. In essence, being proactive rather than reactive is crucial. With the right information and diversification strategy, you can navigate any market climate with confidence and resilience. Investing isn't just about profiting when times are good, it's about surviving and thriving when they're not. Let's delve into the psychological aspect of investing, arguably as important as any financial analysis. Human emotions often drive market moves more than fundamentals. Fear and greed are the twin emotions that most frequently lead investors astray. In 1929, when the market was booming, greed drove prices beyond sustainable levels, and when reality hit, fear accelerated the crash. Recognizing this emotional roller coaster is crucial. Developing a mindset that embraces patience and level-headedness helps in avoiding impulsive decisions. Set clear investment goals, whether it's for retirement, buying a house, or achieving financial independence, to stay anchored through market noise. Then, there's the power of discipline. Create and stick to an investment plan. Regularly review your portfolio, but avoid the temptation to react to every market hiccup. Think long-term. Over decades, markets tend to recover and grow despite periodic downturns. This perspective can help mitigate fear during bear markets and prevent rash decisions during bull runs. Tools like stop-loss orders can also be instrumental. They automatically sell a stock if it drops to a certain price, providing a safety net and helping mitigate major losses. In the end, it's more than just numbers. It's about understanding your own biases and instincts. By managing your emotions and maintaining discipline, you can make confident financial decisions, ensuring your investment journey is not only profitable, but also a learning experience. To wrap it all up, spotting the signs of a potential market crash, diversifying wisely, and maintaining a disciplined, emotion-managed approach is your trifecta for investment success. History offers crucial lessons, like those from 1929, and with the right strategies, you can navigate even the toughest market conditions with confidence. If you found this information valuable, why not subscribe to our channel? You'll get more insights to stay informed and ahead in the financial game. Don't miss out on the chance to turn uncertainty into opportunity. Again, hit that subscribe button, and let's tackle the markets together.